Hi, y'all. Today I'm going to be talking about all the new SAVE program updates that will be happening in July. So, if you're on the SAVE program, if you're one of the 4 million people who have enrolled and gotten $0 payments, please listen up. And for those who have enrolled and not have received $0 payments, it's actually even more important to you all because there's going to be a recalculation in the formula and the payments, and that really impacts people when they do monthly planning. So please listen up. If you are enrolled in any income-driven plan, if you are a public servant or trying to get PSLF, public service loan forgiveness, or just trying to go for regular loan forgiveness, either one of these processes, please listen up. Also, we have till June, the end of this month, to also, if you have FFEL loans, so if you borrowed your student loans before 2010, to consolidate them. I want to encourage people to do that in this video as well. But I'm going to create a series of videos, including on the bar defense program, which we're processing applications for. I will make some additional videos on that as well. So please stay tuned. Please like and subscribe and share this if you have friends or family for whom this content may be relevant. Okay, so let me just make that quick public service announcement. So let me dive in and go into the SAVE program update. Okay, the biggest change that's happening in the SAVE program is that we are getting the payments capped at 5% for undergrad loans, okay, and 10% for graduate loans. So let me explain what the payment cap is and what the percentage is about. Okay, so when your student loan payment is calculated, the government calculates it using what's called discretionary income. Discretionary income is simply a formula, and it is a formula that takes your income and minuses a specific percentage of poverty. So in the case of SAVE, it's 225% of poverty in your state is reduced from your income, your adjusted gross income, and whatever the cap percent. So let's say you have 100% of undergrad loans, for example, you only went to undergrad, then they will only take 5% after they minus the poverty line of 225%. They only take 5% of what's remaining, and they will say you can only pay you'll only pay 5% of that. If you have grad school loans, let's say you have I use the example of 100% undergrad loans, so they'll only use 5% now of the remaining balance of your income minus the 225% of poverty. Only 5% will be used, okay? Let's say you have a mix of 50% undergrad loans and 50% grad loans, which I'm using a straight up percentage to make it easy. Then 50%, it will use 5% for 50% of the loans and 10%. So you'll have a slightly higher requirement for grad school loans. Let me know if you want me to do the math and do a straight up example, or if somebody has an example with their own income and the percent of undergrad and grad school loans. Please comment below. I'm happy to do the full out calculation for people who are interested in those details. But again, please comment and please ask your questions, because that helps me also understand what kind of content and videos people like to watch. So that's a quick overview for those that don't care about all the mathematical craziness. Know that the reason why it actually does matter to know what the calculation is because it's great to calculate your own payment, right? And know that your loan servicer is doing it correctly, because sometimes we just can't rely on them to calculate everything and do everything correctly for us because they're managing millions of people's accounts, okay? So what's going to happen while the program goes into law? It's supposed to start going into law in July. What is happening is there are delays, and when there are delays in recalculating, which I don't understand why they aren't using software to recalculate instantaneously everybody's payments, but of course they're inefficient and they're not doing that. Instead, they're relying, I don't know the process internally, but all I know is it is causing delays in recalculation and getting out people's statements on what their new payments are going to be. As a result, what they're going to do is they are going to put many people into 1 and possibly 2 or 3 months of forbearance. That forbearance time, fortunately for us as borrowers, will get counted towards loan forgiveness. So what does that mean? That means that you pay $0 and you still get it counted as if you made a payment, just like during the pandemic pause. That means, let's say you're a public servant, you work for 10 years. By the way, you have to certify all your employment to get your 10 years counted. So if you need help with that, we can help at LoanSense. If you have any questions, we can help with that as well. But what that essentially means, to go back to my point, because I stray off a little sometimes, is these 1 to 3 payments that they are going to put on pause or forbearance will count as a payment as if you made it. So that means if you have 10 years of payments, let's say you've already made 1 year, plus you got 3 years of pandemic pause, plus you're getting another 2 months of pause now, all that time counts as if you're making a payment. So even though the Biden administration isn't directly coming out and saying, we're going to give mass loan forgiveness, which is what the media and like all these people going psycho and nuts about, it's a way to give people actually loan forgiveness without coming out in the media and blitzing it and saying, we're giving everybody loan forgiveness. They're just counting pauses in payments as payments. So that's essentially, let's say that month you were supposed to pay $400. They say you don't pay $400, we're pausing it. That's essentially $400 that you are getting in loan forgiveness. So that's pretty cool. Also, any associated interest is forgiven as well. When I say associated interest, as in like if that $400 payment covers some form of interest, some form of principal, that $400 is essentially forgiven because you're not going to be required to pay it. So now let's say you made 1 year payments, they count 3 years of the pandemic pause plus these 1 to 3 additional months, they count it as payments. So you made 1 year of payments and you're essentially getting 4 years as if you're making payments counted, which means if you're a public servant, you only have 6 more years to pay. Essentially, you're getting 4 years of payments forgiven. That is loan forgiveness, okay? It's not an official loan forgiveness program. It is literally just administrative pause that is by, as a result, forgiving your student loans. Let me know if you have questions about that so that I can answer them. So that's what's happening right now. SAVE is just going to, the Department of Ed is going to recalculate to recognize 5% of discretionary income for undergrad loans and 10% for grad school loans. That recalculation is causing a huge delay and you may be put into forbearance. Do not freak out. It's nothing you did wrong. It's not your fault. But just know that you can hold your servicer accountable for calculating it properly by doing the calculation yourself. I'm going to draft, I'm going to detail the discretionary income formula in the comments so that you understand how it's done so that you could possibly do it yourself. If you want a detailed video specifically on how to do the calculations, I'll get in front of a whiteboard. Just comment below if you want to understand that further. Let's see here. Oh, I wanted to make one other comment. If you are trying to get loan forgiveness, but on a 20-year plan, for example, not the 10-year public service loan forgiveness plan, I'm sorry, it's 25 years most likely. It honestly depends on how much debt you took in undergrad if you're enrolled in SAVE. So I won't even say a specific year, but all the time that the administration counts a payment you didn't make as a payment, it will reduce that amount of time from your overall length of payment. So if you took out $13,000, I think you pay for 11 years, 14, you pay for 12 years, and the amount that you borrow up after a certain amount of time, it goes to 25 years if you're not a public servant. We get the question all the time, well, what if I was a public servant, I worked for nonprofit or government, then I come out to the private sector? Does that mean all the time I've worked in public sector doesn't count? It doesn't mean that. It just means you should still certify those employers. And let's say you go back to nonprofit, you have an additional couple years to work, and then your loans are forgiven. Either way, you should still qualify and certify for the public service employment and those employers because you don't want to lose that time from the possibility of getting public service loan forgiveness. So just wanted to make that statement as well. Just because you decide to work for the private sector for a few years doesn't mean all the prior payments get erased. Okay, so those are some common questions we get asked. I wanted to answer them here. Just know that sometimes when you get these notices, it's a cause for panic. It's a cause for confusion. We totally understand. We're here on standby. You can get a complete plan on what your new payment would be at myloansense.com. Just sign up for an account for free, get started. We can tell you what it's going to be. If you want additional advice, want additional information on filing or not filing, what to file, we can be of help. You literally just click enroll in our app and you can get assigned somebody to meet with and speak with about what the best course of action is for you. Let us know if we can help. Have a great day. Please watch my other videos, especially if bar defense is relevant to you or you may have questions. Again, like, comment, subscribe. We look forward to helping you, and I hope this content has been helpful.